Imagine a tidal wave of cars sweeping across the globe, faster and stronger than anyone expected. 1 month, a 34% surge, $112 billion in exports. And behind this unstoppable force, China. Yes, the same nation that has been quietly building factories, refining technology, and undercutting competitors for years, is now dominating the global auto market. In just a few decades, China has gone from producing small, affordable cars for domestic consumption to becoming the world's leading exporter of vehicles. And now, it's not just about quantity. It's about technology, pricing, and scale. Electric vehicles, hybrids, and traditional gasoline cars, all flooding markets in the US, Europe, and beyond. Automakers like BYD, Geely, and Chery are no longer just local players. They are global disruptors, challenging the likes of Tesla, Toyota, and Volkswagen on multiple fronts. So what's behind this unprecedented surge? Why are Chinese cars suddenly irresistible to consumers worldwide? The answer lies in a combination of aggressive pricing, advanced technology, and strategic government support. Chinese EVs, for example, often cost tens of thousands less than comparable Tesla models, while offering similar or even superior battery life and tech features. Add to that a well-oiled supply chain and favorable trade policies, and you have a perfect storm that the US and EU auto industries are struggling to counter. Consider this. In April alone, Chinese automakers shipped over 1 million vehicles internationally. That's a figure higher than the combined exports of several major European automakers. 1 month, 1 million cars. And the numbers keep climbing. Analysts are calling it an hot auto tsunami. And the ripple effects are already being felt in Detroit, Munich, and Tokyo. But it's not just the numbers that are impressive. The story of China's automotive rise is a story of strategy. Take BYD, for instance. Once a small battery maker, BYD has transformed into one of the world's leading EV manufacturers. By vertically integrating battery production, car assembly, and software development, BYD controls costs and quality in a way that few Western competitors can match. Geely and Chery have followed similar paths, blending innovation with aggressive market penetration. And let's not ignore the global context. While China's auto exports are surging, US and European automakers are facing rising production costs, supply chain disruptions, and slower adoption of EV technology in some segments. This gap creates a perfect opportunity for Chinese manufacturers to capture market share rapidly. They're not just participating, they're reshaping the industry. But here's the kicker. This isn't a temporary spike. This is part of a calculated, long-term strategy. China understands that the future of mobility is electric, connected, and autonomous. By dominating exports today, they are setting the stage to dictate the global auto standards of tomorrow. Now let's dig deeper into the numbers. How did $112 billion worth of vehicles get exported in just a single month? Which markets are driving demand? And what does this mean for Tesla, Volkswagen, and Ford? To understand the full impact, we need to analyze both the macroeconomic forces and the micro-level strategies fueling this surge. China's automotive industry is backed by a mix of state support, private enterprise agility, and consumer-focused innovation. The government provides subsidies for EV production, invests heavily in battery technology, and builds the infrastructure necessary for global logistics. Meanwhile, companies like BYD are leveraging these advantages to expand rapidly overseas. The result? Exports that are not only large in volume, but also competitive in price and appealing in quality. So the question is no longer whether China can challenge the global automotive giants. The question is, how fast can the rest of the world respond? Because right now, the auto tsunami is rolling, and it's leaving US and European manufacturers scrambling to keep up. Let's start with the stars of this surge: BYD, Geely, and Chery. These names might sound unfamiliar to some, but in markets like Europe, Southeast Asia, and even the US, they're quickly becoming household names. BYD is the poster child of China's EV revolution. Once known as a small battery manufacturer, it has transformed into a global automotive powerhouse. Its secret? Vertical integration. BYD makes its own batteries, assembles its own cars, and even develops proprietary software for its electric vehicles. This control over the entire production chain allows BYD to reduce costs, improve quality, and scale rapidly, advantages that competitors like Tesla can't match entirely. Geely, on the other hand, has taken a slightly different approach. Instead of relying solely on domestic growth, Geely has aggressively acquired international brands such as Volvo and Lotus, blending Western engineering with Chinese manufacturing efficiency. This gives Geely instant credibility in markets where Chinese products were once viewed skeptically. And then there's Chery, which is quietly making waves with a mix of affordable EVs and hybrids that combine practicality with tech-savvy features. But these companies aren't just exporting cars, they're exporting strategy. Let's consider pricing. In Europe, a BYD electric SUV costs roughly $35,000, while a comparable Tesla model sits at $48,000. That's a nearly 30% price advantage for similar or even superior technology. When you factor in government incentives for EV adoption, suddenly the value proposition for consumers is undeniable. Now, it's not only price and technology that are driving this tsunami, it's also timing. Chinese automakers have capitalized on global supply chain disruptions caused by the pandemic and geopolitical tensions. While US and European manufacturers struggle with chip shortages, rising labor costs, and regulatory hurdles, China has leveraged its domestic manufacturing base to maintain output and keep costs low. This efficiency translates into competitive export prices and consistent availability, two factors critical for capturing international market share. Another factor is the growing global appetite for electric vehicles. Governments across Europe and North America are incentivizing EV adoption through subsidies, tax breaks, and infrastructure investment. Chinese automakers, with their wide range of affordable EVs, are perfectly positioned to meet this demand. And it's not just about quantity, they're also innovating. Some BYD models, for example, offer battery ranges exceeding 500 kilometers on a single charge, advanced autonomous features, and cutting-edge infotainment systems. Consumers are getting a lot more car for their money. And let's talk about the impact on global automakers. Tesla, once the unquestioned leader in EVs, is now facing fierce competition not just from established automakers like Ford and Volkswagen, but from these nimble Chinese competitors who can undercut prices while maintaining quality. Traditional gas-powered giants like Toyota and Honda are feeling the pressure too, as even hybrids and conventional vehicles from China are competitively priced and increasingly reliable. So, what does this mean for the US and EU auto industries? For starters, they can't rely on brand loyalty alone anymore. Consumers are becoming more value-conscious, willing to try new brands if the technology and price make sense. This forces Western automakers to accelerate innovation, reduce costs, and rethink their global strategies, or risk losing market share to these fast-moving Chinese players. The implications extend beyond car sales. Supply chains, investment strategies, and even employment in manufacturing hubs are all affected. Investors are now paying close attention to Chinese automakers because their growth isn't just domestic. It's global companies that were previously regional players are suddenly global competitors, influencing everything from stock valuations to trade negotiations. But here's a critical question. How sustainable is this surge? Can China maintain this pace, or is this a temporary spike fueled by one-off advantages like low labor costs and favorable government policies? Early indicators suggest this growth is more structural than cyclical. China's investment in EV technology, battery innovation, and international marketing is long-term. They're not just flooding markets, they're building an ecosystem designed to dominate for decades. So, what does this $112 billion auto tsunami really mean for the world? The simple answer: disruption. The global automotive hierarchy is shifting before our eyes, and those who fail to adapt risk being left behind. In the US, Automakers like Ford and GM are feeling the pressure. While they scramble to electrify their fleets, Chinese competitors are already shipping EVs that are affordable, technologically advanced, and widely available for European giants like Volkswagen, Toyota, and BMW. The challenge is similar. Even with decades of experience, brand recognition, and loyal customers, they now face competition that is faster, cheaper, and increasingly innovative. But it's not all doom and gloom. Disruption breeds opportunity. Investors who understand this shift can position themselves to benefit companies involved in battery technology, EV infrastructure, and global logistics are poised to see growth. And consumers? They're winning too. More choices, better technology, and lower prices are forcing every automaker to up their game. Let's zoom out for a moment. This surge isn't just about cars, it's about power, influence, and strategy. China isn't just exporting vehicles, it's exporting its industrial model, its approach to technology, and its vision for the future. By dominating the EV market and expanding globally, China is setting the standards that the rest of the world will follow. Autonomous driving, battery efficiency, and smart vehicle technology will increasingly be shaped by Chinese innovation. And here's the irony. The US and EU have the resources, talent, and innovation to respond, but speed and coordination matter. Chinese automakers aren't waiting. They are executing with precision, backed by government support and an integrated supply chain. The rest of the world is playing catch-up. So, what should we take away from this auto tsunami? First, China is no longer just a manufacturing hub for cheap goods. It is a global competitor in high-tech, high-value industries. Second, disruption is here, and it's accelerating. Automakers, investors, and consumers must adapt quickly or risk being left behind. And finally, opportunity often comes disguised as challenge. Those who understand the shift, anticipate trends, and invest wisely can profit from this seismic change in the automotive landscape. As we watch this unfold, one thing is clear. The global automotive world will never look the same. The $112 billion surge isn't a blip. It's the opening chapter of a new era, one where Chinese vehicles and technology dominate showrooms, highways, and investors' portfolios. If this video gave you insights into the future of the automotive market, make sure to like, comment, and share your thoughts. Are you surprised by China's rapid rise in vehicle exports? Which automakers do you think will adapt, and who might fall behind? And don't forget to subscribe and hit the notification bell for more in-depth analysis on global finance and economics. The world is changing fast, and here at the Financial Economist, we'll help you understand exactly what it means for your money and your future.